Good afternoon and welcome to our weekly webinar. I'm Kathy Fettke, co-CEO of Real Wealth Network, and this has been our most popular webinar so far in terms of registration. So welcome. Clearly, this is a hot topic. How do we prepare for the 2020 economy? So finding out what that 2020 economy might look like is the key. I have done many webinars on the topic, at least trying to predict what's coming. And really, where I've been so lucky is I've been able to interview people on the Real Wealth Show who have much more experience than me. That's how Real Wealth Network really started, was having this opportunity and this platform to interview people who have been in real estate, in all aspects of real estate, for more than 2 decades, often 3 or even 4 decades, or at least 4 downturns, so that they can really help us understand what they saw before, what they maybe didn't see, how they recovered, what they're seeing today. And that has just been really helpful for our members at Real Wealth Network. So this is the first time we've done this as a webinar. I've done these kind of interviews on the Real Wealth Show. So I'm excited to do this for personal reasons, because I am, again, lucky enough to have surrounded myself with people like our speaker today, our guest today, Fred Bates, who's just got an incredible track record and has made really good choices, has learned a lot through the last 30, 40 years that he's been doing this. And I get to ask him lots of questions. So here is our disclaimer. If you're new to Real Wealth Network, this is really important to understand that we are just telling you our opinions today. Don't take it as fact. It is simply an opinion. Always run things by your personal accountant, whether it's your CPA or your attorney, your advisors. You could take this information we share with you to decide if it's right for you, but please don't take anything we say as fact. Past performance is no guarantee of future results. And it's really important to understand that real estate purchases are subject to risk. It's simply how it is. Really, any investment is subject to risk. And real estate, in my opinion, has less because it's tied to a hard asset, but that doesn't mean there's not risk. There always is. And you can mitigate it, and that's what we're going to be talking about today, is how to mitigate it. But with any investment, there's also always the possibility of loss. So again, in this webinar, we will make every effort to maintain accurate and current information, but things do change. And we haven't totally mastered the reading the future process, but we're getting there. So, but what if you could? What if you could see into the future? Would anything have been different for you? Would you have done anything different, say, in 1999 or in maybe the 80s or just recently in 2006? If you could see more clearly what was coming and kind of know what data to look at, do you think you might have made more money, lost less money? This is the key that everybody's trying to figure out. We don't totally have it nailed, but we've got some really good ideas that we're going to share with you today. And when I say we, I'm talking about one of our partners, one of the developers that we syndicate with and build single family homes in not emerging markets, but in good, strong markets. Some are emerging. Fred Bates, a lot of you know him. He has over 43 years experience in real estate, in development, construction. He's owned multifamily, he's built multifamily, he's built lots of subdivisions, golf courses, all kinds of things. So he has an incredible track record. He's made some really good choices over the past 40 years, and it's going to be just really interesting to get inside his head and figure out what he's thinking now. So welcome, Fred. It's really great to have you here.
Great, Kathy. Good to hear from you. How are you doing?
Good. I'm just about to get on a flight to New York.
I don't know how you do it.
I don't either. But here, I just want to let people know just a couple of past projects you've done. You've done so many, but these might be some that people have driven by and recognize. One is the Regent on the Green in Walnut Creek. It's a 48 condo development downtown, right across from where our Walnut Creek office was before. Beautiful building. Wish I had a unit there. I wish I'd bought it when you built it, or I wish I knew you then. And then Ivy Hill
I still have
Apartments.
that one right there, the top one.
Yeah, you got to save the best unit. That's, I guess, the benefit of being the developer. So that's right downtown Walnut Creek. Ivy Hill Apartments in Walnut Creek, 190 apartments. Now these are just apartments. You've done subdivisions and all over the Bay Area and also in Monterey and other states as well.
Correct.
And with Real Wealth Network, we've done 9 projects together over the past 8 years. Now, a lot of you who are on this webinar already have heard about Fred, and you are probably invested in some of our syndications with him, some of these past ones, but a lot of people have not heard about him or any of these deals, and there's a reason for that. There are SEC laws that are very, very specific. If we're going to raise money for our projects, we can only present those to people with whom we have a pre-existing relationship. And the SEC defines that very clearly as what that means. But what it means is we need to know you, we need to have a conversation with you, we need to know what your goals are, what your financial situation is. It's not just like you signed up at our website and became a member and now we have a relationship. So it doesn't work that way. We actually have to know who you are. So if you haven't heard about these projects, it's because maybe we haven't done that. We haven't gotten to know you personally, and we'd like to. So if you want to find out about future projects, you would just need to start by having a strategy session with one of our investment counselors. It's free. You can do that by signing up at the website, and then you can also fill out the investor questionnaire. Now, it's a lot of personal questions, and a lot of people who join say, I'm not going to give you that information, and I don't blame you. You shouldn't until you get to know us better. But the reason we ask for those questions is so that we can unlock the parts of our website that we're allowed to show you. So for those of you who don't know about these projects, we're going to go into it in a little bit more detail. But the very first one we did with Fred was back in, I think you reached out to me maybe in 2009, Fred, and
That's correct. Right in the heart of the recession.
Yeah, and that was a scary time. Now, I had helped a lot of people avoid the recession by helping them sell their bubble properties in California, their overpriced properties, and 1031 exchange them into emerging markets like Texas. These were single family rentals, and a lot of people who listened and did that avoided the recession completely. I didn't take my own advice on a couple of properties, kept a couple of properties in Boise where the market just crashed, and kept a couple in San Francisco Bay Area, and they lost about half their equity. So, I am since very obsessed with understanding markets. That's why you hear me talking about it all the time, and that's why I like to ask people like Fred, who doesn't freak out about it. He just looks at the data, right? And that's what we're going to do today. So I bring that up because, Fred, when you contacted me, I was licking my wounds in 2009. We had lost a couple of properties to short sale, lost a bunch of money in them because I didn't follow my own advice. And then you came along and said that you had this deal in Portland that was 70% complete. The banks had come to you during the last several recessions to unload properties that they had to take back and didn't know what to do with. This time was no different. They had this project, waterfront in Portland, 70% complete. The bank failed. The FDIC took it over. They didn't want it. They didn't know how to finish it out, but you did. So the asset manager contacted you. It was going to be you needed $3 million to acquire all 27 townhomes and finish them out. Someone told you about us, and we met. And I remember my first thought, like, are you kidding me? It's 2009. This is, who's got money to finish these projects out? Who's going to buy them? Everything's in foreclosure. Half of Portland, most of the Portland condos were empty and worth nothing. And, here was this project, and I didn't know how to move forward, but you were very confident. So let's just kind of go back to that moment when really the U.S. economy had flatlined. It was a mess. People were afraid to do anything. But you came to me and you had complete confidence in this project. Why?
Well, keep in mind, one of the things that you mentioned, that you lost properties to short sales. That's leverage situation. The second thing was that this particular piece of property that we were looking at had the previous developer had lost it. Why? Because he was leveraged into it. Now, not so much on his side did he lose it, but the bank that he had the mortgage with went under. The FDIC took it back, and of course the first thing they do is they just demand that you pay them or they take the property back. So they took the property back, and it was available on the marketplace. We took a stab at it. If you recall, they had, I think there was roughly $13 million in debt against the property. As you said, the land was, they had the land and they had the buildings about 70% clear. So we made kind of a little bit of a wild offer. We were very conservative. We went in at $3.5 million on it, bought the property. In this particular case, we did do a leveraged build out. If you recall, we went ahead and got a construction loan, went in, finished off the homes, and turned around and sold them. And we realized a nice little profit on that in a relatively short period of time.
Yeah, but I remember at the time saying, how could we possibly sell these in a down market when there's so much inventory? There was nothing but condos, slashed prices, no buyers. What gave you the confidence to move forward on something when we were in that kind of a market, a down market?
Based on our buy, we were able to finish these off at below market rates and sell them really below market rates. These were waterfront properties right on the Willamette River. We sold our first one, if you recall, at about $480,000. Our last one we sold at about $1 million. So we were in a rising market. We knew that. There was a lot of competition for REO sales, short sales, whatever. But we had location and we had a superior product at a low price.
I think that was one of the differentiators is the condos were high rise. These were pretty low rise and townhomes, and there wasn't another product like it. And it was in the Pearl District, one of the most popular parts of town. So, we went for it and it worked, and it was, really impressive. Excuse me, really impressive. Which brought us to the next deal that you brought our way was Dublin, and this was still pretty much in the heart of the recession. Tell us a little bit about that and how you structured it to protect investors.
Well, again, during these down markets, there are opportunity markets for buyers, people that have cash, buy in those markets, buy low, sell high. In this particular case, a fellow owned I call it a woody walk-up. It was an old office building on, 13, 14 acres, 200 and some thousand square foot walk-up building, and it was about 30% leased, and he wanted to get rid of a headache. We went in, we got an option to buy, and of course that put us in a pretty good situation. We didn't need a lot of money. All we needed was entitlement money. So we raised the entitlement money through you. This allowed us to go ahead and get the property rezoned for single family detached, and we did that. And I think our pro forma, I think we bought the land at 10. We figured we would sell it around $15-16 million. We were all in at probably about 12 million with the option payments and in the entitlement process, and we were able to secure an offer for around 20 million. So it was a very good project at a time when I think most people figured the economy was still down, but we turned around and sold it to Pulte Homes, who was anxious to get building in the Bay Area.
Yeah, so again, a time when people were really paralyzed in fear, and that was just a total home run. So these other projects are great too. We're going to talk about them a little bit further, but you can see we've done a lot of projects. There's some still in progress. They are closed. You cannot invest in these. If you want to invest in any of Fred's future projects, again, you would need to have a personal relationship with me at Real Wealth Network, which again means talking to an investment counselor, filling out the investor form, and then we'll be able to invite you to those webinars and tell you about those future projects. All right, so, oops, this is one of the Reno deal was really great. Well, let's just talk about that for a minute. One of the next projects we did was in Reno, and we had so many developers coming to us saying Reno's the new hot market, but they couldn't find anything or they were overbidding for land. And somehow in the midst of all these developers bidding and outbidding on land and offering too much, you found a deal. So how did you do that? And now an up market, once the market takes off, boy, it's hard to compete.
And it was hard to compete. The public builders were back in here building. We have Toll Brother, Lennar, D.R. Horton. And what we found was a good piece of property in a desirable area that, for lack of a better word, I'd say it had some hair on it. The people that owned it had to come up with a quick sale because they had a hard money loan on it. We had negotiated on this property a year before, but they wouldn't take our price. But then they came back to us and asked if we could close quick, and if we could, they would give us our price, which was well below the market price for that type of land. And so we were able to get into the Reno market.
Now, we talked about leverage before. What did they do wrong with their leverage scenario, their loan situation?
Well, they were totally loaded up, and they were cross-collateralized. The people that sold this property to us had probably a half a dozen projects that they were getting entitled. They had options on, or they had loans on, and they had it all consolidated with one lender who had them all cross-collateralized and was threatening foreclosure on everything. So they had to do a rather large pay down. And so we got it, like I say, at our price. I keep using that word leverage because to me, it's the thing that, as you know, that I will not do.
Yeah, I mean, I was a mortgage broker. I'm all about leverage, but the right kind, and I see a lot of people out there just taking on massive debt, and it does concern me. So we're going to talk about when you will and won't take on debt. Okay, so here is our website. I imagine y'all have seen this, but if you go to log in, you would join, and then that's when you would be able to fill out the investor questionnaire. And if you, or you'd be able to book that appointment with an investment counselor. Now, unfortunately, to invest in any syndication like Fred's, you do have to either be accredited or sophisticated. So there are some kind of guidelines about that. To be accredited, you have to have a $200,000 income as an individual, or $300,000 as a couple, or have $1 million net worth excluding your home equity. Now, there are ways around that. You can get an equity line, or you can take the cash out refi and put that money somewhere, and then it does count. Or you could be a sophisticated investor, which means that you really understand the investment, and we would question you on that. These are SEC rules. We just have to follow the rules. So that, again, might be why you haven't heard of some of these. But let's talk about recession fears, Fred, because here we are. It's 10 years later from when we met. 10 years ago, the U.S. economy, the world economy was just, like I said, flatlined and in a deep recession, and people weren't sure if there was going to be a United States of America. I had stocked up on food and supplies and all that stuff. And here we are today. We're seeing a lot of headlines about these recession fears, like all kinds of reasons why people think there is one. It's the inverted yield curve, the tariffs, the national debt, elections, impeachment, negative interest rates. I mean, every single day there's a new headline with some expert screaming that you better be careful, buy gold, get your money out of the bank, and sell everything you've got, trying to scare people. So what are your thoughts on these topics?
Well, Kathy, I read the same thing everybody else reads, and this particular type of headline that you just played there plays on the reader's emotions, and they'll read that and it will sensitize them. Whereas an article that I just read stating that the housing market is booming probably has little effect on them. It's the sensational stuff that affects them most. We've never been in a situation like we're in before. We've got record high, stock market, real estate prices are reaching historical highs. Unemployment is nearing historical lows. Interest rates are low. Inflation is low. Income is at historical highs. We've never been in this situation, especially where we have low interest rates and low inflation. So I think we're going into uncharted waters, and this disturbs some people. For me, this is the environment that we've all been looking for. If you wanted to paint the perfect economic picture, this would be it. And yet some people are looking for faults in it. I read just yesterday, you may have read it in the Wall Street Journal also, where banks were showing large profits this last quarter over the same quarter a year before. So this, I think, plays on to one's emotions. If you look at the inverted curve, I understand what they're looking at here. I mean, this signaled the last two of the last three recessions, but some of the experts that I'm reading are saying that this is a different time, a whole set of different circumstances. So the inverted curve is just one of the things that one would look at when trying to figure out the economy. Tariffs. I'm sure tariffs bother everybody. We'd hate to see the trade wars going on. We did see prices go up. I'm going to speak primarily in my business, but I'm sure prices are going up at the grocery store and every place else. But we've also seen the tariffs work. Our lumber tariffs, when they imposed tariffs on lumber from Canada, it put our lumber prices at an all-time high for us. However, the tariff caused Canada and the United States to work out a trade agreement, and the tariffs came off. And with the overabundance of lumber right now, our lumber went down about 41%. The national debt, economists have answers for this kind of stuff. I don't particularly like debt, so I frown on it, but what they'll tell you is that our biggest debt holder is ourselves, and that it's okay as a percentage of the GDP. Now, I don't know if that gives anybody any satisfaction, but that's their answer to it. Elections, this is kind of a political thing. I don't see much in our business world. The people that I'm talking to, our buyers, the people I'm doing business with, aren't paying too much attention to the elections, the impeachment process. The negative interest rates, I think, would be bad for us and for our economy. Again, these are all our own personal opinions. We like to see some interest rate. In other words, if you're the person who is relying on interest income to allow you to get by, then we would like to see some interest rates. We can still provide interest rates and have low interest rates for our bank financing, for mortgages and so on.
Okay. So do you have any concerns then about the economy? It sounds like you're pretty positive.
Well, I think we always have to look at what the economy is doing. And of course, that's where I think some of us differ. I go to strictly data, and other people read headlines. And I think the headlines, again, play on the emotions of one. It takes a lot to have a healthy economy and only a little bit to rock the boat. Right now, I look at it as all the stars are aligned right. And this is about as good economy as we're going to have. But you're already seeing people try to rock the boat. I think in our business, and we'll get into it a little later on, it looks good for the next 5-6 years.
Wow. Okay, so here's just an example. We keep hearing about, recession, but here's the US GDP growth. We don't really look anywhere near a recession at this time.
No, we don't look like we're near a recession. But the other thing too is these charts can be a little bit misleading. Not that I, want to destroy anybody's image of this chart, because it's beautifully laid out. But you notice all the boom markets have been after recessions. But at the same time, we've been pretty steady, it looks like, since after 2010. It's been relatively steady. So I think we're in a good place without, a hyperboil in the marketplace. So it looks good.
Now, I'm actually going to New York to do a bunch of interviews, and I'm being interviewed a lot by the mainstream media, and sometimes I show up on the set and there'll be a big sign behind me that says housing slump, what are we going to do? These are the headlines we see all the time, and it does affect buyers, and it's sort of a self-fulfilling prophecy, right? But
Right.
in reality, here's home prices. So when we look at this, we're not really seeing a housing slump, are we?
Right. And historically, I mentioned to you one time that I had purchased my first house um, in Michigan on the lake for $18,000. That same house today would be selling for well over $1 million. Real estate over the long haul is going to appreciate and is going to be a good business. I feel that most of the reaction to this type of uncertainty was led by the Fed's raising the interest rates in 2018, and 2019 has been kind of a year of rejuvenation for single-family home builders. It was kind of a mild recession for us, and I say that because we continued to build and sell homes through 2018. However, with the sharply lowering interest rates that we have now, it's eased affordability. So the same person, for example, that was priced out of a house when the interest rates were closing in on 5%, now is back in the market because his house payment is substantially less now that we're down below 3 or below 4%. One of the things that you don't see in these graphs is what's happening for orders. So our market slowed down last year. It's gradually picked up this year. What's really picking up is our orders. We're starting to get out in front and build for people who've put in an order for a home, and these will be closing along with homes that we have already standing on the market. So our own production and closings will start going up, but it's that way throughout the nation. I think that people are looking at slower reacting data sets. The other thing that we look at, other metrics that we look at are mortgage demand. So right now there's a lot of applications in for mortgages. We talked to other home builders, so we've got home builder sentiment, and they're all feeling the same thing that we're feeling. Right now for us, it's probably the brightest picture we've had in the last 3 years.
Wow. Okay. So what the headlines really should say, and they are now, is that the crisis is not a housing slump. It's a lack of just a lack of new supply. So let's see the real. I can't
Yeah,
see what the
that's
headline says,
and
but
that's it too. I mean, you see here 2008 to 2016, houses were below historical highs. And of course, a lot of that is due to the lack of lots that are available. It's getting harder to entitle property, but new home construction has been slow to recover since the plunging during the recession. And however, by nearly every metric that we look at, the U.S. has been significantly under building homes, particularly the single family homes. And this has not just been the last few years, it's been over the last decade. Long-term fundamentals continue to support healthy and growing demands for single family homes. And we look at the 2020s, and as home values are going to rise amid a continued housing shortage. So I know one of your graphs show that housing shortage kind of tapering off by 2024, but the things that we're looking at, we just continue to see a higher demand and a lower ability to meet the demands because we don't have the lots, et cetera, et cetera, et cetera. Yeah, this is a graph that I had looked at earlier that it looks like in 2024, demand will go down, but I just don't see it. Here in Reno, for example,
it
and you'll
wasn't so much
remember,
demand. It's I think what this was from Metro Study, and I think the undersupply, the lack of homes will continue all the way up into well into next year. And then I think builders will start to come online and provide more supply, and that's what this is. And so there'll be more supply, and it will start to meet equilibrium, but basically a lack of housing until
Right. And
until
so
that.
supply over and under is all about demand. So I call it demand, they call it supply.
Okay.
So,
All right.
right. One and the same. And so it looks like the supply would be going down, or the demand for housing would be going down by 2024. But for example, here in Reno, if you'll recall, when we were trying to buy in here, we were looking at demands for housing at about 5,000, 4,000, 5,000 a year. And of course, we've never hit those demands. Now they're talking about that demand was for a 5-year period between 2015 and 2020. We haven't hit those demands. Now they're talking about demands for 6,000 to 7,000 homes a year to meet the demands through 2020, 25. So, and I think that's the way it is across the nation. We're just unable to meet the demands.
Okay. In markets that have jobs, there's definitely markets that are where inventory is not moving, but there's reasons for that.
Well, yes, and we're right. This chart that you bring up right now is one that would indicate why some real estate is not, our markets are not moving. They're getting a little top heavy, and of course, we too have been kind of the victims that a lot of it's been caused by increased entitlement time. Time means money. Cost to entitle. The last project that, years ago we could get a project entitled for $150,000. The last project I entitled cost us over $2 million to get it entitled. Well, that's all the cost against the cost of development. Increased fees by the cities and counties are pushing up prices. Increased land costs, as you know, Kathy, it's getting harder and harder to buy land any place that would have entitlements or have the ability to get entitlements. People who are selling the land realize how dear it's getting. But all these go to increase building costs and final price. What we try to do as a builder is we look at a market like Reno, we talk to the buyers in the marketplace, and we try to provide them with a certain type of house. They want a certain type of house with finishes, certain size, look, everything. So they have certain expectations. And when we go out to try and meet that today, the price of the house gets pretty costly. As you know, we are shifting gears a little bit on our project at the Prescott Ranch and our project in Carson City on Little Lane. We're downsizing. We're going to cheaper construction, smaller lots, in an attempt to provide more affordable housing in that bigger market range, and we'll get faster absorption there. But it's a tough balance today.
Yeah, absolutely. Okay, and again, we're talking about building homes and selling them retail. I know a lot of our audience is interested in buying homes as rentals. So it's a totally different market, but kind of helps you to see, or helps me to see, that for many of our affiliates, we have 15 affiliates nationwide that are finding older homes, fixing them up to our standards and creating rental units. They are often between $80,000 and $120,000 homes. So you can see there's a real lack of inventory on that end. So it's amazing that we are able to go in and provide that kind of affordable housing. So it's not brand new. Like there's no way you could build it for, in some areas we're still building for 120,000, but certainly not on the West Coast.
Yes, and again, on the West Coast, it all comes down to land costs, but even and construction costs, labor. We talked about all of the things that go into make up the cost of the house, so it's all getting higher.
Yep. Okay. And this is another important slide to just show that we're not at all in the same market that we were before 10 years ago when the mortgage crisis hit, people couldn't afford their loans. They didn't even have to qualify for them. We all know that story. Today, it's such a different story. People did have to qualify. They have home equity. They're locked into low payments that they can afford. There's not going to be an adjustment like there was in 2006 and 7 that threw everything off when the loan adjusted. People couldn't pay them. Well, these are fixed rate mortgages, so very, very different situation today. Mortgage debt well below household equity, so people aren't just going to walk away if they lose their job. And so anyone who's listening, there's people, I tell you, Fred, I run into events where there'll be some guy in the front row saying, with his arms crossed, saying, I'm just going to wait till the market collapses and I'm going to get my deals then. What are your thoughts on that? Is he going to be waiting a long time?
Well, I'm hoping he's waiting a long time. I understand what he's saying. Certainly you can understand, based on this graph, why household equity is above debt. And of course, that you can see all the appreciation that we've had. But in many markets, you mentioned Boise a little while ago, and of course, you and I know about Reno. These hit all-time lows during that last recession. They've clawed all of that back and then some. So if we do go into a recession, it doesn't mean you should sell. Even if your property falls below your debt, it doesn't mean you should necessarily sell, especially if you're going to take a loss or jeopardize your credit. Yes, opportunities would come along during the down market, but it doesn't mean you should sell. Your real estate will come back and then some.
Okay. Let's see. Mortgage delinquencies are down, so we're not
So
seeing
you would
trouble there.
expect that in this type of an economy. And delinquencies, you talked about job losses. Delinquencies start when there are job losses. And this economy, we talked about a little bit about tariffs, and some of the tariffs put on caused some new job creations in our area, because the tariffs didn't make any sense in producing the product in China or someplace and bringing it back here. So they moved the company back here to produce it, and of course, more jobs. But as long as the economy is running good, we won't see delinquencies. But if there are job losses, we'll start seeing them again.
So given that you have been through several recessions, you know that they come and they often come after a booming market. So with that in mind, what projects do you just toss out immediately and why?
Well, the simple criteria is location. That can be the city that it's located in, what part of a given city, the size of a project that we want to do, whether it's entitled or unentitled, what the entitlement process would be, how friendly is that city to entitling property, do they need growth, and can I buy it as a non-leveraged project, make 20% in a conservative analysis. If I need to leverage the project to make it work, I simply won't do it.
So when you have hundreds of deals come across your desk all the time, you'll see red flags and just toss them right away. So a slim margin, what would that be? What would you consider a slim margin?
Well, a slim margin to me is what most national builders are willing to do. They'll go ahead and they'll build a project, they'll take down a project with a 10% margin on a leveraged project. And of course, I won't do that. We're paying our money, our cost of money is around 15%, and I still want to make 20% over and above that. And I want to make it without penciling in any inflation. I want to make it without showing lot premiums. I want to make it without showing that we will make money on builder upgrades. Just on the simplest of analysis, I want to be able to make our 20%. Then if something goes wrong, we can hunker down and we can outlast it. But debt obviously is the death knell to most of the projects that fail. Of course, flat markets, we like to be in a growing market, but we can deal with a flat market. You have too many national home builders, and of course, when we came into Reno, we have 3 national home builders here, Toll Brothers, Lennar, and D.R. Horton, and we can certainly compete against them. I did look at a project up in Boise that I wanted real bad. Toll Brothers took that project and they went into Boise in a big way. I'm still looking at Boise, but now I have to be a little bit more particular because these large public builders can build for less than I can build. So we have to find a niche. We have to do a better product at the same price. So it requires us to buy better. And when I say buy better, I mean on the land, because they get better buys on materials. For example, the same steel tub that we would put in the house, they can get it about $800 cheaper than I can buy it, just on their national leverage.
Wow. Okay. Let's see. So again, you already mentioned this, but what deals do you further pursue? And it's the bigger margins, at least 20% profit without debt. Pro-growth city councils, that's a big one. You're not building in California anymore for that reason, right?
Right. And, going back to what cities, I don't know if I mentioned this to you before, but the Milken Institute said the best cities for future growth and appreciation, and this is based on what the younger population is looking for, and even a lot of the retirement population, are small towns, small to mid-sized towns, college towns, very high. And I really agree. I spent a lot of time looking at that analysis, and I totally agree. And one of the reasons Bozeman is growing, and I say growing, everything's relative. It has gone from 35,000 to 50,000 people over the last 8 or 9 years. It's steady growth. It's looking for a couple thousand permits, or 1,200 permits a year, maybe more now. Prices have nearly doubled in Bozeman because there just isn't anybody there building true production houses. So we're going to go in there and we will be the large builder in the Bozeman area. But I love it. It's a college town. It's booming. I would love to be in Boise. I would love to be in Salt Lake. There are places I'd love to be. Just can't get there. Haven't found the right deal yet.
Okay. So what are the highlights of your initial due diligence? What are you looking at?
I think it's all in the buy for me. We want to make a great buy, not just a good buy. We want to be able to make a lot of money in a good market and still make good money in a average market. We want to see steady growth in that market. We want to see, as you say, pro-growth city councils and so on. We need all of our entitlements in place before we would ever close on a deal. So we might option a deal and entitle it ourselves. And of course, that's always good. And we did that just recently down here at Little Lane. We want to complete all of our due diligence before spending any big money on planning or engineering. And again, it must work without leverage. That's the highest criteria I put in anything, is it's got to work without leverage. And I think, Kathy, I've told you why I have this thing with leverage. During the late 80s and the early 90s, during that savings loan debacle, when the savings loans had loaned a ton of money out, and they were also your investment partner in a lot of these deals. As those banks were starting to go under, as the feds were putting pressure on them to take developments back that were non-performing, they brought us in. We were not, at that particular point, a builder developer with any debt at all. Matter of fact, we were doing very few projects because we couldn't afford to buy the land at the inflated rates. But in only a short period of time, we were able to turn those projects around. We were able to get them entitled and get them sold, or build them out ourselves if they were under construction, finish them off and sell them out into the marketplace. In other words, any of these projects, all of the projects, would have succeeded if they had the time. But because they had debt on it, because the feds go to the bank, if you're not making your payment, they look at that as bad debt. The feds say they've got to get their loan balances down, so they have to foreclose on those, write those loans, those projects off, and then bring them back to the marketplace and sell them out. All of them would have succeeded if they weren't leveraged, and they would have all made money. So I stay away from it because of what I saw during that period.
All right. And then you mentioned that some of the challenges you are seeing is the 5 Ls: lending, lumber, labor, land, and legislation.
Yes, and the lending right now, we're probably as good as it's going to get. We are at low interest rates, below 4%. I think that that augments well for our business. Lumber prices are down about 41%. Labor is up, but on the good side of that is labor is up kind of across the board, and it's brought more people into the home buying market, and more people are employed. Land cost, as you know, Kathy, the land is everything for us. If the land doesn't work on, for example, just a straight, I look at it, if I can't buy the land today and sell it tomorrow for more than I'm paying for it, then I probably am not interested in that land. And then, of course, legislation. It's getting so tough to entitle properties that we like them already entitled, but so does every other developer builder. So
Right.
many times we have to tie them up like we did Little Lane and go ahead and get them entitled ourselves. A lot of the big builders just aren't doing that anymore.
So you'll tie up, for example, with Little Lane, you'll be in a purchase sale agreement, but we don't close until the entitlements are in place, but we're doing the entitlements.
That's right. In Little Lane, we did a purchase and sale agreement, and it was all subject to us getting our entitlements. The closing was. In other projects, we'll do an option. If it's going to take longer to get the entitlements, we'll just do a simple option on the project. We'll go in and get our entitlements, and then and only then will we close. And of course, like we did in Dublin, we went ahead and got our entitlements. We had two ways to go. We could have went forward and built that, but the business plan was to sell it, and we took it to the marketplace, and we got a strong enough offer, so we did sell it. And if you look at what we did up in Bozeman, Montana, if you recall, we bought that property for $3 million. The day we got it entitled, $3 million at 600 lots is maybe 5,000 a lot or something like that. The day we got it entitled, the lot values went to, paper lot values are $30,000 a paper lot. Now we're in there finishing the lots off. Finished lots are worth about $90,000 a piece up there, 90 to 110, depending on lot size. And those that we're finishing off, we're going to take the next step and build homes. We have people coming to us every day up there wanting to buy a single lot or a number of lots. We've created value. So entitlement's a good way to go. It's just getting more and more difficult.
Mm-hmm. Okay. So we've been really talking about our projects that we've done together, which is building homes, selling them to the public as primary residences. But most of our audience is interested in cash flow, single family, multifamily, commercial property. I imagine you have different guidelines for that, and I've got my little bullet points on the next page, but you don't have the same thoughts on leverage when it comes to cash flow property, because that really increases the return, right?
That's right. You have to leverage into that to make it work. And you've put enough pressure on me, Kathy, that I will be coming to you at some point with an income property. Now, the way I am going to approach this is a little different than going straight out and doing an apartment project. And we've done quite a few of those over the years, myself and my partners have. And typically we use bond financing to make them work. That's very low interest rates. And you've had to put in 20% affordable housing and whatnot into those projects. And that, of course, is still available to us, but it's a very expensive process unto itself. What I'm trying to come up with right now, Kathy, is a project that we would have a mixed use development where we'd have a little industrial, so income property, we'd have a little commercial, some apartments, multifamily, and residential. What we would do is we'd go into that based on a relatively long-term hold. We'd go in, we'd build out the single family detached, which would reduce our basis in the rest of the property, take all of that money that we made out of the single family detached and put it into the apartments, office buildings, commercial, and whatnot, and then hold those for a period of time and sell them, or hold for an indefinite period of time.
Well, I can almost hear the clapping on the other end because people have been asking for this for so long. So hopefully we can bring that online. There's just something I want to clarify because there's a lot of private placements going around, a lot of syndications, a lot of new people in the apartment world doing syndications, and they're talking about cash flow, but they're not really talking about cash flow. So let me explain this. What we just spent the last 45 minutes or 50 minutes on is talking about building homes, selling homes, and making a profit, not holding for cash flow. A lot of the PPMs I see out there are basically doing the same thing. They're buying apartments, they are fixing them up, increasing the value, and selling them. So they're just basically flipping apartments. These are not cash flow deals. So when you look at an actual cash flow, like if you're actually buying a single family home or an apartment that you're holding on to for cash flow, not to flip, what would be a typical return that people could expect?
Um, it starts out, the first 3 years, there's typically no return. After that, it's going to start out probably someplace between 6 and 8%, all sheltered, unless we go to bond financing, whereby we typically sell the tax credits to keep our investor costs down, and we have a lower interest rate. We could conceivably get that up to maybe a 10% initial cash flow, but then it grows subject to the market. So I've had apartment complexes that we've built in the past, and I'm going to say in San Jose. I'm thinking of one that when we built it, we came into a market that was with about 5 other large apartment buildings being built at the same time. So our cash flow in the first 2 or 3 years was relatively small, but as that market continued to grow, our cash flow grew exponentially, and we grew up to probably about a 17% cash on cash flow. So we had a real good return. We turned around then, and we were in that project at conception at about a 12% cap. Initially, it went down, as I say, as other apartments came online. Then it went up. But we turned around and we sold it at a 4.5 cap. So the money that we made on that was just ungodly. But that's what can happen in this type of development. And if we can keep the last few apartments that I've tried to bring you, they were so cash intensive that I just didn't want to go to your people and have to raise that kind of cash. As you know, I like to keep the debt to 65% or less. I mean, I think 60% would be the max that probably what I would do myself, and still have a nice cash flow. And it gets tougher and tougher. You've got to raise a lot of cash to do that. Land costs, everything, upfront costs are very high, and you really don't start getting the cash return until it's built and leased up, and that whole process takes about 3 years.
So yeah, I just really want to make sure that people understand when you're looking at these PPMs and what other people are doing, the multifamily, you know, what am I trying to say? Oh, I want to say fix and flip, but value add. The multifamily value add is really nothing more than a flip, and you have to understand that in order to flip it, you need to know where the market's going to be in 3 or 4 or 5 years, whenever that's supposed to happen. So, in my opinion, a better way to go about truly building wealth with a cash flowing apartment would be to do the value add, get the deal, get the right price on it, bring up the value, increase the rents over time, refinance into long-term debt, pay all the capital back as much as you can, and then now you've got a cash flowing asset. But what I'm seeing is people just selling it, and now you've got a capital gain, which is now you got to pay taxes.
Right, and that's true. The other thing in these long-term holds, we can set them up so if somebody, at that time that they're cash flowing, they have a stated value. Everybody's share has a stated value. So if somebody wanted to go out, typically what we do is we offer it out within our own group, and somebody will grab it up, and there's a fair market value to that. So it's pretty easy to accommodate both people that want long-term holds and people who would want to get out in 5 years or 7 years or 10 years.
Okay. All right. Well, we are almost out of time. So I think you probably said it all, but what would you see as the bright spots for the future looking at 2020 and beyond?
Well, Kathy, I'm not really one that can tell you what's going to happen on a global basis or um, even probably a local basis. I can tell you more about single family detached probably than anything. And I think the future looks bright. Everything I see through 2024, 2025 looks bright for single family detached. That's about as far out as any of us would want to look. And I think that the marketplaces that we're picking are especially bright. So I'm thinking we've got a real bright future in single family detached building and development.
In those areas, wonderful. And then, I of course love the rental homes and in the areas where there's cash flow and potential for growth. Okay, well, I'll just take a couple questions. There's probably a bunch, but like I said, I got to catch a flight. Let's see. You were able to. It's great that you were able to acquire these deals at the bottom of the market, but now we're in a market with all-time highs that is close to a bubble. Is it a good time to be buying? So again, it comes back to buying what, right? Buying a rental, buying buying land and building on it.
Right, and I know where they're coming from, and of course that's what I'm saying. That's the inability that we have to buy much right now is because we won't pay top of the market prices. We look at what's the worst case scenario going to be. So no, we're not buying a lot right now. If we find the right deal, if we could find, like we did up in Bozeman, where we could buy 150 acres for $3 million and get it entitled for 600 lots, yes, we would go ahead and do that. A lot of those, there's not many of those out there. So we're looking every day, but we have to be careful.
Okay, this is a great question. Fred, you're a successful developer with a great track record, healthy returns. Why are you using RWN, which is expensive? Don't you have cheaper money available from banks?
And of course, the answer is, we've given the answer probably 5 times today. And that is, I started in this business doing syndications. And it's kind of like I'm ending in this business doing syndications. In between, I did leverage deals with banks. And of course, we were fortunate enough to learn a wise lesson in the 90s without getting caught up in it. And that was the leverage deals in the down market. They couldn't meet their bank calls, and so consequently they lost their projects. So I'm just not willing to do that. We went to institutional money after that, And institutional money was basically our partner, but they were our limited partner. Now institutional money, if they come into a deal with you, they want to control your business. They want you to do all your development with them, and they want to have a guy sitting at the seat with you. Most of these guys are not real estate or development type people, and they would tell you to cut and run at a time that maybe it would be, we would think that it wouldn't be wise to cut and run. They're sitting at the table when we do our product analysis and decide what product we're going to use. They have a voice on that. So it gets hard to deal with institutional money. So we're dealing with the syndicated money, and it's our election to pay that 15%. We don't have to go out and put it out at 15%, but we think it's a good return for our investors, one, and two, if we can buy the deal that we want, we don't mind paying that rate. Yes, we could turn around and we could leverage it, but the day you do that, if you hit a slowdown in the market, it can all be gone.
How can you find out whether someone has cross-collateralized their assets?
If somebody has cross-collateralized their assets, I mean, if we have an asset, we would know that if we cross-collateralized it. I'm not sure if you.
I think he was probably just wondering how you found out these.
Oh, well, so when we did the title report, I see.
At that parcel,
when
and they
we
probably
did the
just told
title
you.
report, we saw this, the size of the lien and what the security was for the lien when we were looking at the title report for the property that we were buying. And of course, our offer was to make sure that we were delivered that property free and clear of any debt.
Okay. How do you explain the drop in home prices in the San Francisco Bay Area?
Again, this is something you and I talked a little bit about the other day, is that builders were paying too much for land and too much for construction costs and too much for infrastructure, and people were chasing it. There's too much high income housing up there. People simply can't afford it. Prices are going to have to come down because payrolls have not gone up to that level. So I think that San Francisco has, and I'm saying the Bay Area in general, everything on the peninsula down through San Jose is probably at the saturation point.
Yeah, I think also less Chinese buyers, right? And
well, Chinese, you can talk about the Chinese buyers. You can talk about the latest regulations, tax regulations, whereby you can't deduct your mortgage payment. There's just a whole lot going on that would affect, and of course, mortgage increases. Now mortgages are coming down. It might lessen that a little bit, but there was a lot of things going against California real estate over the last year and a half, 2 years.
And really it comes down to affordability, and San Francisco became the least affordable city in the country. And so most of us were thinking, okay, it's a bubble. And that's what it was. Let's see, sorry. Is Fred seeing the effects of millennials being unable to afford their first home?
We see that, but at the same time, the stuff that I'm reading is that there's one train of thought where people are saying that millennials don't want to buy, they don't want to own. We're not seeing that. We're seeing them come to the models. They want to buy, they want to own. They just don't have the equity today. Research is telling us that they're going to be the biggest segment of home buyers in a very short period of time, and that they do want to own. And so, again, if all the stars remain the same, mortgage rates stay down, jobs stay good, I think we could be in the biggest housing boom ever.
Amazing. Okay. Making a great buy is, of course, important, but how on earth do you get one today when
it's tough? And you know, Kathy, how many times the number of offers I make in relationship to the number of deals we actually get. So I might get one deal out of every 10 offers I submit. And I submit offers only on the deals that I think we might be able to get that would pass muster. So we do due diligence on well over 100 projects a year. It's very difficult to buy. You have to be patient. It just comes down to you setting your standards and not buying if they don't meet your standards.
Yep. Okay, someone asked, what do you mean about not using leverage? Aren't you using leverage when you work with Real Wealth Network?
Not really. They're partners, and we're all capital. It's all, everything we own free and clear. It's all capital. There's no debt.
Yeah, so I think the difference, to explain, it's a capital stack where if you're buying a home and you go to a bank and get a loan, you put 20% down, the bank puts 80% down. But if you instead said, I'm going to go to 5 family members and everybody's going to put $20,000 in, there's 5 of us, that's 100, we bought the property, we don't need bank debt. So you're not having to make payments to anybody and nobody can foreclose on you. So that's how it works with Real Wealth Network, is we come in as equity partners with our developers. Okay, status on projects. We'll have updates soon. Fred, you're working on that for
Right.
next week?
I'll try to get those out this weekend. Right.
Okay. Okay. Entitlements basically mean when you buy a piece of land, you have to have permission to build something on it, and what most cities are very involved in what that is. So it's approvals from the city to build, basically, getting through all the environmental and so forth. Preparing for 2020 economy means what specifically for investors who may not have the financial resources but are doing turnkey acquisitions. So yeah, it's a great question. We've really been talking about Fred and what he's seeing as a home builder, but that very much applies to the housing market in general. And what he's saying is there's going to be strong demand for the next 5 years, basically, because of a lack of housing. Now, that affects people who need to rent as well if there's just not enough affordable housing. What's wonderful about the affiliates that we have around the country is they're able to buy properties for half of what it would cost to build. And not in all cases, but in a lot of cases, they're finding properties that a builder could never do at that price point. They're older homes, but the big ticket items are replaced. So you're able to rent out that home and meet the demand for affordable housing. So that's what's great about the cash flow properties. But it's important for us to be understanding what home builders are doing too. If they bring on too much supply, that affects our rentals. But what Fred is saying is it's going to be a long time before builders could possibly bring in enough supply to meet demand. And it's almost impossible to bring in affordable housing. Very, very difficult to do.
One other thing, Kathy, that I'd like to make a note of is that the one question that you had was buying property today, and are we at all-time highs and things like that. And of course, the other thing that we have to keep in mind that we're home builders at this point, and we kind of have to build through thick and thin, because if we don't buy today and prices continue to rise, we'd be the loser on that. But if we can buy today and get a good deal on a piece of property that will work for us even in a recession, then we're ahead of the deal. We're still building and whatnot. The person that really suffers is the person that waits for an all-time low. They miss it. They sell when markets move up because they're afraid to hang on for the all-time high. You take Warren Buffett. He buys based on long-term strategy, and things have proven to go up. So again, if it goes down, it'll be for a short period of time. Since we're all equity, we can ride it out.
Okay. Someone asked if the Reno opportunity is still available. That sold out years ago, but just log in to the website to see what our current projects are. I can't talk about them publicly, sorry. Okay, someone wants to know what keeps you going. You don't need to be working, so why do you?
I don't know what else I would do. We've talked about this. You and I have talked about this. This does not work for me. I was Monday, Tuesday, and Wednesday, I was up in Bozeman, and we're coming out of the ground up there. We've got streets and water and sewer in place. We've poured foundations. We're framing up houses and models right now. It's all exciting to me. I love it. There's a limit to what we can do. We're going to stay a small company, but we can do 6, 7 projects, and it's fun to be involved with it.
I was going to say your family's involved too, so that probably makes it fun to be mentoring your children.
Yeah. Sure, all of it, all of that's true.
Yeah. Someone wants to know, final question is, what do you think of Fresno and Clovis area? Well,
I did a development back in Clovis, actually. I didn't build it out myself. We got it entitled and we sold it to another builder out there. We tried to do a builder out in and around the Four Corners area north of Fresno. We didn't get our entitlements there, and we went away from it. This was in the late 80s, early 90s. And so we did not develop that property. We had an option on the property. I think it's probably a good area. I myself am not, Kathy knows this, doing any more projects in California. It's just too tough. The entitlement process is tough. It's still a good market, I think, from a real estate standpoint. But from a builder standpoint, where everything is earned income, you pay state and federal tax, your combined tax is over 50%. They don't take any of the risks. They take 50% of the profits. I'm just not going there anymore.
Yeah, and we're just running into entitlement issues on projects that we do have. So yeah, and even if you own rental property in California, you've got new regulations there. So we're just, I'm with you there. I don't like doing business in California, sadly, because I love the state, born and raised here.
Yeah.
All right, Fred. Well, I got to run. Thank you so much for sharing your insight with us. It's just been wonderful. Yeah, and thank you all for joining me. We had a great turnout. We'll get this edited and recorded and posted on our website and on YouTube. So have a wonderful rest of your day, everybody. Thank you so much.
Thank you.
Okay.
Bye-bye.
Bye-bye.